welcome back to the channel. My name is Stock Brock. Today I want to talk about some retail and restaurant earnings for quarter three and how the US consumer is actually doing at the moment, from Walmart to Target to McDonald's and Starbucks. The numbers tell a mixed story, so let's break it all down really quickly. Let's do this. So, a couple of the retail giants, we have Walmart, Target, and Costco. Walmart had quarter three revenue growth of about 4 to 5% year over year, driven by grocery strength, but management noted some trade down behavior, meaning consumers are buying cheaper brands. Guidance was cautious for holiday spending. Target sales actually declined around 4%, with traffic lower, but profit margins improving as they cleaned up inventory. That shows a more selective shopper, but fewer impulse buys, more essentials. And it also shows that a retailer like Target, which is a little bit more expensive than Walmart, some of the shoppers are going to a place like Walmart rather than Target, as you can see with the decline in the spending year over year. We have Costco, steady as ever, as expected, around 6% revenue growth with strong traffic, membership renewal rates around over 90%, and Costco continues to benefit from people looking for bulk value. And now we got apparel and discretionary. Nike reported flat to slightly down revenue, and management warned of softer demand in North America as consumers tighten up. Lululemon held up better with double-digit growth internationally, but guidance suggested slower momentum going into quarter four. Home Depot and Lowe's both showed negative comps as home improvement spending cooled off. Another sign consumers are pausing on big ticket purchases. And as you can see, the housing in home builder stocks are not doing very well, especially year to date. And we still have mortgage rates pretty high, so demand for home buying is not there as well. For restaurants and food chains, we have McDonald's posted a 3% same-store sales growth, but warned about global traffic softening and value sensitivity. Starbucks missed estimates. US comps were down low single digits. Management cut full-year guidance, citing cautious consumers and weaker China demand. And then, of course, everyone's favorite, Chipotle, bucked the trend with mid to high single-digit growth, still benefiting from menu pricing and traffic. So dining is holding, but only for brands that balance value with perceived quality. But these aren't good numbers. This is definitely telling you the consumer is pulling back quite a bit, trying to cook more at home. Not a lot of growth in the retail stocks. Specialty and e-commerce. Over specialty retail, Amazon saw double-digit growth as the convenience and improved delivery is benefiting mainly from AWS and advertising. Consumer discretionary on their site grew modestly, but Prime engagement stayed strong. And now we have Ulta and TJ Maxx and Marshalls. Both reported low to mid single-digit growth, proving value and personal care still attract spending, even when budgets are tight. So, what's the takeaway? Consumers are still spending, but they're choosing value, staples, and experiences. As you can see, Airbnb came out with great numbers today. Haven't dived in too deep, but saw a news headline that their numbers look good, so gotta believe it. Growth is slowing in discretionary categories like apparel and home goods. Big box and discount chains are outperforming, while mid-tier brands are feeling the squeeze. Management across the board keeps warning holiday spending might be softer than usual. In short, the consumer isn't broken just yet, but the wallet is getting thinner. If you got value from today, the quick comparison, hit the like, comment, subscribe. Thanks for watching. Stock Brock. Peace.